All right, cool. So let's talk about the mechanism of insurance. And let's start from the very beginning, And this is an interesting piece as far as the very beginning is concerned. And the reason I say that is because, check this out. So here you are. This is you. You're the individual, right? And the moment you're born, this is kind of weird. Why am I taking it back to the moment that you're born? Well, the moment you're born, guess what? Risk is born with you. Risk is born with you. Isn't that interesting? An interesting thought? Like the moment you're born, risk is born with you. And what risk is born with you? What's the risk? As soon as you're born, what's the risk?
Life.
Thank you. Loss of life.
Yeah.
Right? One of the things that was said in the class last night, that the breathwork class that I'm taking, it was interesting because I don't remember hearing this, but I remember writing it down. It's interesting to remember not hearing it, but remember writing it down. And one of the things that she says is the thing that is with you the thing that is your best friend and closest to you is the thing that is born with you and dies with you, and that's your breath. Isn't that powerful? Like your breath is with you from beginning to end. And so having a relationship with your breath is so important, because really that's what, as soon as you're born, you already have a sense of what risk is. And that's the loss of something, the need for something, the want for something, right? And then losing that, like the potential for losing that. And so when we look at it from that perspective, loss of life, right? So the first risk is death. Mm-hmm. And that's a human loss, right? That's a human loss that every single person, no matter who you are, that's part of our humanity, that we have this risk of loss of life. And then eventually, we evolve. We like to think we evolve and we start to grow up. And then we rely on our parents, don't we? So we've got our parents, whether we grew up with one or two parents, we still have our parents. And see, how many of you got into trouble when you were a kid? Charles. Oh, Kristen too. I thought I would think you were a good girl, Kristen. So you got into trouble. Yeah. And I don't know what kind of trouble you got into, but let's just say you got the kind of trouble into where you maybe vandalized, you were adventurous, and you broke windows, and then maybe that's not even an adventure. You're just playing baseball and you break a window, right? Now, when you break a window, when the window is broken, right, that's a property loss. And then you broke the window. Who is responsible for you breaking that window, Charles? If you're 10 years old and you threw a baseball, you hit the baseball into somebody's window.
Parents.
That's right. And then your parents are held liable, right? There's a liability component to this. So check this out. No matter where we're at in our life, we always have risk. From the moment you're born, you've got the risk because there's a possibility of the loss of life. As you grow up and you evolve, your actions have the consequence of if you cause damage or loss to someone else's person or to someone else, there's a liability component to that, where that person will be held responsible for covering that loss. And what type of losses? Property losses, right? It could be a window. It could be, guess what? You start to drive. You're a teenager and you begin to drive. And oh no, actually, I didn't get into my first accident until I was like 27. But if I was a teenager, if I was in my teens and I hit a car, right? Or hit someone, that would be property loss as well by hitting another car. And then hurting someone else would be the liability piece of it. Now, as an adult, let's say now you're an adult, right? And I want to demonstrate something here. See, in the beginning, you're relying on your parents. But as an adult, there's this learn and earn concept. This is important because over time, we learn. And some people actually start off in debt because you've got that student debt, right? So now we're looking at income, and we're either going to start off with a minus or we're going to start off with a positive. But it depends. So if you're starting down here, over time, you're going to start to work, learn and earn, and your income earning potential, right? Now you're accumulating stuff. At the beginning, you're relying on who?
Parents.
Parents.
The parents, right? And then eventually get to a point where you got to rely on yourself. And now all of the stuff that you had, all that property you had, really it was your parents, wasn't it? Because you're going to get to a point where all of a sudden you start developing and buying your own property and buying your own stuff. Like you buy your own car, right? Again, I'm not the best artist. Maybe you buy a house or you rent, because the implications are the same. Whether you rent or you own, you're going to fill that house. And you're going to fill that house with what we call personal property. What would be an example of personal property?
Bedroom set.
Yeah, like your bedroom set, your
Couches,
couch. Yeah.
chairs.
Chairs. How big is your TV, Charles? You probably have a really big TV.
It's 65 inches.
Oh my goodness, 65-inch television? Does it really need to be that big?
It does. It absolutely does.
Okay. But I mean, you catch my drift though, right? Where we start to, that's supposed to be a 65-inch television. So you start building all this stuff, and check this out. As you evolve in your career, not only are you supposed to be making more money, but you have more stuff. And if you have more stuff, that means you have more stuff to protect. If you have more stuff to protect, that means that you have the potential to lose more. See, when we're over here, are we concerned about risk? When you're young and you're like right before your learn and earn stage, before you go off on your own and you break off from mom and dad, you're probably more likely to take more risk. But as you get older, you've got more stuff. And you know what? You've got experience and you hear stories. What you hear, what you heard, what you experience, and you start to develop an intolerance to risk. You start to make like reasons as to why you can't do certain things because there's a potential for risk. But you know what? We've had risk our entire lives. You've had risk your entire life. And so what mechanism can we put in place to protect against these losses? Because there's one more loss I want to identify here. Because what happens along the path here is that you have the potential of getting sick. Your greatest asset is what? What is your greatest asset?
Health.
Your health, which is really your income. Your ability to earn an income is your greatest asset. People think that it's their houses, their cars, their stuff. But your stuff is not your greatest asset because you can lose all that stuff. But if you get hurt and you get sick, then you can potentially lose the ability to earn an income. Now, of course, we have our exceptions and our, individuals that no matter what happens to them, they're going to overcome it, right? They're going to find a way to make income even if they're sick. The general population, though, if they get sick or become disabled and they can't go back to earn an income, then where do they get that income from? How do they protect against that? All right. So there's loss resulting from sickness. I'm going to spell this out because I put sick and I'm going to add sickness. And then, or disability. Let's put disability in there. That's the word you need to know anyways. And then there's this other thing here that happens as we get older. Once we get older, the curve for earning income during your income earning years is an upward curve, and then it starts to go down. Now, I don't have enough space here, and yeah, it doesn't let me move the screen. And so I want to point out here, though, there's a point here where your earned income starts to diminish. And you get to a point where you're no longer working. What do we call that?
Retirement?
Yes, retirement. And when you get to retirement, there is a loss of income that results from that. Because you're no longer, and it's not like your investment income, I'm talking about earned income. As you get older, you get to this place where, you know what, you're not working anymore. Like you don't have the same energy that you had when you were younger. Does that make sense?
Yeah.
believe that, but that's what I heard. And I've kind of experienced that myself, where I'm not as
Active.
or let me give you an example. I have a friend who is an ultra marathon runner. Okay, I'm just gonna tell you, she's my sister. She's an ultra marathon runner, right? Actually, she's kind of an anomaly though, but she was go, 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 always on the go, 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 literally on the run, right? Because an ultra marathon runner runs 100-mile races and 24-hour races. The reason I share that with you is she slowed down. She doesn't run those ultra marathon runs because it just takes too much out of her body. And that's part of the aging process. So you're going to get to this place here where you're going to go into retirement. And you're going to rely on all of the money you saved up while you were working and had that earned income coming in. This is one of the risks that a big part of our population is facing this risk. They say that in 2035, 20% of the population will be over 65. They're going to be over 65. And we have an aging population. Well, you're probably wondering, well, what does that mean to you? What that means to you is that you need to start thinking about, depending on where you're at, right? If you're in your 20s, am I going to be thinking about retirement?
No.
In my 30s? I might hear my older friends complain about it. Like, oh, I need to start saving for retirement or whatever, right? But I mean, at this point, hopefully you're participating in the plans that your employer offers you. You don't know why, but you know that you're supposed to. And so you do. But you probably start getting more aggressive in it in your 40s and in your 50s. But it depends. We can't follow a traditional model anymore. This is very traditional, right? People are raising their families. They're buying stuff. But nowadays, people aren't starting families in their 20s. When are they starting families?
40s and 50s.
Their 30s and their 40s. Their 30s and their 40s. And it's very rare to start a family in your 50s. But usually nowadays, they're pushing it to the 30s and 40s. And it's important to recognize that because there is no one size fits all when it comes to risk management. Everything is catered to the person, to the family, to the situation, to where you are in your timeline of your life, right? I mean, nobody really lays out what our life is supposed to look like. And if they do, we don't listen to them because we're teenagers and we know better and they try to teach us this stuff, but it's too abstract and too far away for us to recognize this. But now we're adults and you are helping people plan their future. You're helping people recognize that there's risk. Now, what all of this means is that, let me go back and identify the three principal types of losses. I'm going to use this black pen, right? So the first principal type of loss is a human loss resulting from death, which can happen at any time. And we don't know when it's going to happen, right? Disability, human loss resulting from death, disability, and retirement. And the retirement is more of a personnel loss because you're no longer working, right? You're no longer working. I'm going to use the red to identify property losses. Property losses like someone's window, your car, your house, your TV, all of your stuff are property losses. And then you have your liability. So the three principal types of losses include human loss, property loss, and liability loss. And what's liability? It's when it's my fault. My fault. If you, and the tort that you're protecting against here when you have a liability claim is negligence. They have to prove that you were negligent, that it was your fault, right? And tort is more of it's a civil wrong. It's when you do something to someone else and then they sue you personally, right? It's not criminal. Criminals when you break the law. And then it's not contract law because that has to do with interpreting the contracts and then holding you responsible for what you promised to do in a contract. So there's different bodies of law that govern all of this. Now, the interesting about insurance is that someone can sue you and hold you liable for your actions, and you can have an insurance policy that will pay out on a liability claim. That's kind of cool, right? So we have insurance products that will protect all of these losses that we've talked about that you will experience in your life. And so it begs the question now to talk about, well, what we talked about, all these different types of risk, but really what is the definition of a risk? So on your exam, they love to ask accept questions. So I'm going to give you what it is, and then I'm going to tell you what it's not. So risk is defined as the uncertainty of loss, the possibility of a loss, and the chance of loss. Now, the exception is all of the following pertain to risk except the cause of a loss. I mean, if you look at it, right? I mean, that doesn't fit. It doesn't belong anyways. Uncertainty, possibility, and a chance. The cause is a little bit more concrete, isn't it? Because the cause of a loss is like a loss occurred. The other one, you don't know whether or not the loss occurred. And that's really what a risk is this potential. Anything that you don't take care of or that you don't protect as far as something that you could potentially lose is what we call a loss exposure. A loss exposure is when you have something that is exposed that you do nothing to protect. You do nothing to protect it, right? And there's a potential for loss. That's a loss exposure. The cause of a loss, though, means that a loss actually happened. And then you're looking for like, well, what made it happen? And so an example of that would be a big one, right? We've just had millions of acres burned in the state of California. And so what was the cause of that loss? The millions of acres that were burned in the state of California, where houses were burned and lives were lost. What was the cause of that loss?
One said that it was from a birthday because they were trying to announce the.
No, that's not the cause of the loss. So what was the cause of the loss?
The fire.
Fire.
The fire. So fires, see, it's very, very, very simple. It's not, insurance is not complicated. They can make it very simple. The cause of the loss is a fire. Now, another cause of a loss is this thing, and that's an earthquake. So check it out. The cause of the loss is defined as peril. What's the cause of loss? What do we call them?
Peril.
Thank you. We call them a peril. So all of those acres that were burned, right? The cause of the loss was a fire. Now, and like I said, we had like homes were lost and lives were lost. What if there was an earthquake? See, if you lose your home in an earthquake, are you covered? Is that peril covered?
You have to have specific earthquake insurance, don't you?
Thank you, Charles. Perils are important in the area of property and casualty. That's property and liability. The reason why perils are important is because there's certain perils that are not covered under your property and casualty policy. So like you said, Charles, if you want coverage for earthquake, you actually have to buy a separate earthquake policy to cover against that loss. The houses that were lost in the fire are covered under fire insurance. Fire is covered under your homeowner's policy, but earthquake is not. It's an exclusion. So perils are important because there's certain perils that are not covered in your property and casualty products. But see, in life insurance, we don't care how you die. So those people who died in the fire, if they have life insurance, the policy is going to pay. Does that make sense? There are exceptions, but I'll tell you what the exceptions are. Number one is suicide. But suicide has a limitation. There's a suicide limitation or exclusion only for 2 years. So we like to make a little bit of a joke, although suicide's not something to be joking about. You have 2 years and a day to think about it. Because after 2 years and a day, go for it. Why? Because the policy will pay. Anything less than 2 years, if the insured's death is a result of suicide in the first 2 years of the policy, guess what? They're not going to pay. They don't pay. But after 2 years, they do. If you lied on the application and the insurance company didn't discover it, and then they issue the policy, you better make sure you don't die in the first 2 years because they have the right to contest it in the first 2 years. Isn't this stuff interesting?
Mm-hmm.
I think it is. Nobody ever talks about it like this with us. I know, right? All right. So I've already covered several test questions in this picture. And it looks messy now, right? I'm really sorry. That's just how I draw all over the place. But I hope I illustrated the point and that you can come back to this foundation piece of risk and what we're going to talk about over the next couple of weeks. Because we have insurance and we have solutions for all of these risks that we've listed and identified in this illustration here. And we've already talked about the first one, which is death, right? And what type of product do we have to protect against loss of life or death is life insurance. Life insurance. It pays if you die too soon. It pays if you die too soon because we don't know when we're going to die. So if you don't know when you're going to die, it's too soon. Because we always have something we need to do, right?
Mm-hmm.
Teaching this class has me think a lot about death, you know. And sometimes I wonder, like, wow, if I died right now, look, my office is a mess. Who's going to come clean it up? I better get on purpose and clean it up. There's no insurance for that, by the way. All right. Any questions so far? So we talked about risk, and we define what risk is.
Mm-hmm.
And even though we have all these risks that we take, sometimes there's risks that we want to take, isn't there? Because there's a potential for gain. But there's risk in life that no matter what we do, there is no gain for that risk. It's either loss or no loss. So I'm going to go ahead and let's start a new page here. And let's continue to talk about risk. There's a pure risk, and we have what's called a speculative risk. So all of the risks that we identified in the previous page, right, in that messy illustration, those are all pure risk. If you notice, pure risk is by default, isn't it?
Yeah, it's insurable.
And it's the only one that's insurable. So a pure risk is defined or may result, right? Results in loss or no loss. Whereas a speculative risk results in loss or gain. And sometimes we want to take risk. It's okay to take risk. But you also want to take a calculated risk, don't you? Or maybe you don't take a calculated risk and you just jump right in. I mean, Charles, you took a calculated risk when you got married. How long were you together before you got married? You're a great example. I'm really glad I chose you.
2.5 years.
Oh, you were only together for 2.5 years?
Mm-hmm.
Wow, check you out. So that's a bit of a risk, don't you think?
It was.
Okay, nice. I like that. It was a risk. Okay. And it was a speculative risk that resulted in a gain.
Correct.
Okay, nice. Okay. Well, I got to be careful when I ask that, especially when people are at home. But notice how everything else in life really, let me go back to the other photos. See, all these other things, they're life risks that we take, but they're all pure risk in this illustration, right?
Mm-hmm.
But when you start looking at like, what job should I take? Should I go to school or not go to school? All of those things are speculative risk, which has the potential to result in loss or gain. Now, on your exam, the examples that they're going to give you as far as what's considered, which of the following is a speculative risk or which one is best example of a speculative risk, you're going to look for gambling and investing, right? Gambling and investing. And like Elise pointed out earlier, there's only one type of risk that's insurable, and that's a pure risk. The pure risk is the only one that's insurable because insurance policies are what we call contracts of indemnity. They're contracts of indemnity. And what that means is that the contract is designed, the insurance policy is designed to restore the insured, and I'll describe what that is in a moment, who that is, to restore the insured to the condition enjoyed prior to loss. So it's to restore the insured to the condition enjoyed prior to the loss. No, here's the key here, no chance for gain. Do people try to have a gain out of insurance?
Yes.
Oh my goodness. You know what that's called? If they're
Insurance
lying
fraud.
on the, thank you, Charles. If they're lying on the application, that is exactly what it is. It is insurance fraud.
Mm.
It is insurance fraud. The purpose of insurance is simply to bring you back where you belong, to bring you back to the condition you enjoyed prior to the loss. No chance for gain. No chance for gain. Let's see. So along with that, if we further elaborate on that, right, and we look at risk, other factors that affect risk not only include peril, but it also includes a hazard. So if we look at peril, we defined peril in the previous slide as what? What is the definition of peril? What is the definition of peril?
Cause of loss.
Cause of loss.
Right, it's the cause of a loss. And we went over two examples, but to go a little bit further, you know, like that's a hurricane. I think they're having issues with that, like, or what, Georgia, I think a hurricane just landed. Is that right? Or tornado?
Florida, too.
Yeah, so, and then we have like hail, flood. All of these are examples of perils, right? And as you know, like floods are excluded from your homeowner's policy. Now, what about hazard? What is a hazard? What is a hazard? Is
Increases
that,
probability of a loss.
thank you, Carissa. It increases the likelihood or severity of a loss. So it increases the likelihood or severity of a loss. And there are three different types of hazards. There are, we have morale, and physical hazards. Now, why are hazards important? Because remember, insurance companies are concerned with the losses, right? They're concerned with risk and the potential for losses. Well, risk is the potential for loss. But the peril is the cause, the hazard increases the likelihood or severity of a loss. And the three types are moral, morale, and physical. A moral hazard has to do with your values and habits. What's an example of a moral hazard? What would be an example of a moral hazard?
Leaving the gas on or something.
What do you mean by leaving the gas on?
So what do I mean?
Mm-hmm. Like, what do you mean? I don't know what that means, leaving the gas on. Like, leaving the
like
stove
that.
on?
Yeah.
Because I was thinking, like, shouldn't you leave the gas on? You know, what context? So, yeah, like leaving the stove on, that's more of a morale hazard.
Okay.
Because morale with the E is like carelessness.
Mhm.
Carelessness, indifference. You know, a lot of times people think that the moral and morale hazards are they're so close to each other that one could be the other, right? And the distinction between moral and morale is that morale with an E is unintentional. You don't do it on purpose. Unintentional. But moral is intentional. Moral is intentional. That's the distinction between the two. Unintentional versus intentional.
So
And then-
basically, like crashing your car and saying it got hit while it was parked.
That's dishonesty, right? That is
Right.
total dishonesty. Yes, that's a moral hazard. And then a physical hazard is something that's tangible, material, right? Tangible, material. Oop. And these are this is the framework and this is the foundation to a lot of the insurance terminology that you need to know when it comes to risk, right? Is perils, hazards, morale, physical is tangible. Like, how do we apply a physical hazard to life and health insurance? Well, a physical hazard might be like somebody who has a broken leg. That's a physical hazard, right? And that would affect, like, if you have a broken leg and then you're like walking down the street, you don't have the same, if you have a broken leg, you can't really be walking down the street, but you're in a wheelchair maybe, or you're one of the scooters, you're getting around. It actually makes you, there's a potential for a higher risk because of that physical ailment or disablement, right? Cancer, same thing. If somebody has cancer, they're more likely to, while getting treated, they could die, right? So those are hazards. Those are potential hazards, right? Any questions so far? So we're going to take all of this and go and further define and get into like insurance. So we've already defined that we take risk.
Wait, sorry, do we also have to know legal hazards? I remember reading it.
No, you don't have
I
to know
think-
legal hazard.
Cool, okay.
Yeah, I only cover what you need to know. Legal hazard is more for property and casualty.
Okay, good to know.
I'll give you a real quick example. The McDonald's coffee thing. You guys remember that?
Yeah.
Where the woman, she sued McDonald's for because the coffee was too hot, and everybody thought like, oh, that was such a frivolous lawsuit, and people really judged the situation. But really, what happened is that organizations like McDonald's, right? Organizations like those fast food places or places that make coffee, and then they want to yield a higher, they want to make more coffee out of their coffee beans. If they use hotter water, they'll yield more coffee. And so McDonald's, the problem with McDonald's is that they had gotten in trouble before for making the coffee too hot.
Mm.
And so, because again, negligence, right? They hold you to a higher standard when you know that there's a problem, and then you still do nothing to remedy the problem. And so that's why the settlement was, or the punitive damages, and this is all property and casualty. So if you're taking property and casualties, this is good stuff to know. The punitive damages are basically what they award the person who suffered the loss to punish the person who was responsible for the loss. That's punitive damage, punishing, right? And so people thought like, oh, that's ridiculous. But again, they were punishing McDonald's because they had been violating those laws before. Now, what's a legal hazard? Why is that an example of a legal hazard? Is because now, because of that lawsuit, when you buy a cup of coffee, somewhere on the lid, there's going to be this disclosure that says, be careful, coffee may be hot. If you get a hot cup of coffee and you don't have that disclosure on there, that could that's a liability exposure to the company if they have these lids that were delivered and they don't have the coffee maybe hot on the lid. Does that make sense?
Mm-hmm.
So it's those things where you're supposed to comply with and you don't, and it creates a loss or somebody suffers a loss because you're not complying with the rules and regulations. That is a legal hazard. But see, we don't have those concerns with life insurance and health insurance, right? Because that's more on the person. That's more for you. It's not for somebody else. All right. Now, when we go back, so we were talking about risk. And the funny thing about risk is we said you take risk and you're born with risk. The moment you're born, you have risk. Now, one of the ways to protect against risk is to buy insurance. So we're going to talk about the mechanism of insurance. And the mechanism of insurance is this, is you have this party here, and that's you, the insured. Insured is the person being protected. Who else might we define as the insured?
Policy owner?
Thank you, the policy owner. A lot of times people refer to the insured and the policy owner as the same person. There is a distinction, though, between the two parties. The policy and owner and the insured may be the same person, or they can be two different people. So let's go back to Charles, since he's such a good example. So Charles buys a policy on the wifey. That makes Charles what? Which party does he play? What role is he playing? He is what?
Policy owner.
Yeah, he's the policy owner. And then the wifey, what is she?
Insured.
She's the insured. So she is the object of insurance. She's the person that's being protected, right? Object of insurance. Now, in this class and on the exam, they oftentimes refer to the policy owner and the insured as the same person. They refer to them as the same person. I want you to remember, though, that the policy owner has ownership rights. So the policy owner maintains ownership rights that the insured does not have. And we'll talk about them in greater detail in chapter 4 or session 4. And the ownership rights include policy loans. If you have a permanent policy with cash value, only the policy owner has a right to the policy loan. The policy owner also has the right to cancel. When can you cancel a policy?
At any time.
At any time. When can the insurance company cancel a policy on you?
It's only like if they don't pay the premiums, right?
That's right. So for life and health insurance is very different than property and casualty. Because in life and health, they can cancel only for non-payment of premium. Whereas for property and casualty, they have 3 reasons why they can cancel or non-renew. But life and health, they can't. They can only cancel for one reason, and that's for non-payment. We'll talk more about that later. Policy owner, right to cancel. They may change the beneficiary. They can make, any allowable changes to the policy if the policy allows for it. Exercise any of the policy riders. Then we have this other party over here. So we have the insured on one side and the policy owner, which may or may not be the same person. And then we have, I'm going to put like a helicopter pad on the top of this, right? This is the insurance company. What do we call the insurance company?
Insurer.
That's right. So we have the insured and the insurer. And the insured pays a premium to the insurer. They pay a premium. And what the insurance company does is they take a portion of that premium. So of course the insurance company collects the premium, right? They collect the premium and they're going to take a part of that premium and set it aside. They don't put all the premium, but they're going to take a portion of the premium. And when they set the premium aside, what they're doing is that they're pooling the premiums together. Pooling, I'm going to say, be more specific here. Pooling a portion of the premiums. Now, the purpose for pulling the premiums together is that they're putting these premiums aside and putting them in what's called the reserve account. So what are the reserves? What are these money set aside? Called reserves. What's the purpose of this money? Anybody know? What's the purpose of the reserves?
Offset if something were to happen?
Yep, they're going to pay claims. That money is actually a liability to the company, not even an asset. It's the money's used to pay out claims. So it's the monies used to pay out claims. That's what the reserve accounts are, money set aside.
Quick question, is there was, do they not, is the rest like, is the other part of the portion of the money go directly to the insurance company? That's no portion of what they use to pay claims. That's just how insurance companies are paid.
Right. So the insurance company collects the premium, and then a portion of the premium goes out for claims, and then a portion they keep for their administrative costs, they keep for expenses, they keep for the cost of underwriting the policy, especially in life insurance, Charles. In life insurance, the greatest cost to the insurance company is issuing the policy. And they may not make any money on the policy for 2 or 3 years, depending on the policy type, because a big portion of the first year's annualized premium in life insurance actually goes to the agent as their compensation, right? And
Right.
so, again, they're collecting the premium, but it's going to go towards their profit, their taxes, and all that other expenses involved in running the company. But you have to remember, I mean, we talked about risk, right? Risk is the possibility and the potential for loss. Every person who buys insurance doesn't mean that they're going to file a claim.
Right.
That's what makes the insurance product unique, in that it's unique because it may or may not pay. You might pay literally thousands of dollars in premium and never get anything back. However, what you did get back, and I don't want to say you didn't get anything back, because you did get something back, you got the coverage. Had you suffered a loss, they would pay. But a lot of times people say like, oh my goodness, that's such a waste of money. Well, let me tell you, it's not a waste of money if something happened to you, right? But I'm going to tell you this, the funny thing about insurance is that people might not like paying the premiums, but when it comes to having a claim, they're very happy that they had it.
Right.
Yeah, yeah. You know, they say the true cost of insurance is the claim that goes unpaid. It's the claim that goes unpaid. So going back to this mechanism, I mean, this is how insurance works. I mean, this is, if you wanted to self-insure, if you wanted to protect against your own risk, we're going to talk about risk management in a little bit. And, you know, if you wanted to protect against your own risk, how would you do that? Well, in order to be truly self-insured, that means you have the money set aside to pay the claims. So what do? Is you start putting money aside. I'm going to show you something real quick. You know, one of the things that people ask a lot, you know, I do, one thing I didn't share with you is that I have a small independent health insurance agency. So I help people with individual and family plans. And so, you know, a lot of times they want dental insurance, and I ask them, you know, do you have dental work that needs to be done? Because if they don't, and they just want it because they want the cleaning to be paid by the insurance and all this other stuff, a lot of times they say, you know what, your premium is $50 a month for this coverage here. And 50 times 12 is $300 a year. How much is a cleaning and, you know, just going in and getting your checkup twice a year? And they're like, I don't know. I said, go find out how much it costs. And then they come back and they're like, whoa, it's like less than the 300. So if they can just put the money aside, right? They put them, like, here we go, right? If you put the money aside, and that the purpose of that money is to pay for that cost, do they really need the dental insurance? Well, some people say, well, what if I need a root canal or if I need this other stuff, right? Well, look at the deductibles and the co-insurance on those plans. Is it really worth paying that $50 a month, or should you just save it? So it really goes back to the individual. And, you know, I talk about HSA plans if they have a bronze level coverage, and we'll talk more about that when we get to health insurance. It's just something to think about, because ideally we want our clients to buy insurance to protect against the risk. But sometimes there's other ways to protect against that risk besides buying insurance. And I probably shouldn't be saying that because this is an insurance class. And at the same time, we're talking about risk. And one of the hats that you wear for your client, and one of the things that you help them navigate and that you help them do, is you help them manage the risk. So a lot of times when you take an insurance class, especially in college, if you decide to take a class on insurance, they don't even call it insurance. People don't even know they're taking an insurance class. You know what they're taking? They're taking a risk management class. And that's what you're doing. See, on the very first slide, in the very first picture that we drew, we identified, look, we live with risk. Risk is all around us. The moment you're born with risk. And we identified that, and now we're looking at, oh, okay, well, how do we protect against that risk? Well, one of the tools and one of the products that you offer as a solution to protect against those potential losses is insurance. So if we go back to that illustration here that we started, the person that you're protecting, right, the object of insurance, the policy owner, the insured, pays a premium to the insurance company. And the insurance company takes a portion of the premium and they set that premium aside. And what happens is that one of these, let's say each dollar sign, right, represents a policyholder. So when that policyholder suffers a loss, guess what? All of these premiums that were pulled together help pay for that loss. Because you're trading in your risk by paying a small premium in exchange for what? What are you buying back? What are you getting back when you pay that premium?
Back to where you were when you suffered the loss. I forgot how you said it, but
I love that. So you're being indemnified.
Right. Mhm.
Okay. What else?
God. On the tip of my tongue.
Protection.
What is it?
Basically. Protection, basically. I mean, you're insuring yourself from the unknown in case it were to happen. So if it does happen, you're protected.
You're right, you are protecting yourself from the unknown. But if we go back to that illustration, which I totally lost because I pushed the wrong button, yeah, I won't even bring them back, will you? Darn it. That's okay. It won't take me that long to draw them. So you got your premium. Not going to look as sexy, but that's okay. You got your premium. And what are you getting back? You are getting indemnified. You are getting protection, but I'm looking for a specific word. What are you getting back from the insurer? What are you buying?
you're getting the benefit.
Okay, so you're getting the benefit. So benefit, and these things are all true.
Mhm. Ah,
I'm looking for a specific word. So if I buy a policy, I'm getting a benefit. What else am I getting? Carissa, you have insurance, don't you? Why did you buy the insurance coverage? What was the purpose behind that?
Bridge in case something happens.
Okay, so bridge in case something happens. So that goes back to like indemnifying yourself, right? Protecting.
Yeah. The security.
You've managed the risk.
You are managing the risk when you buy insurance, by the way. I'm going to tell you what it is. Are you guys ready for this?
Yeah.
All right.
When you buy insurance, you're buying a promise. When you buy insurance, you're buying a promise. This is the foundation to the insurance contract, by the way. And when I say insurance contract, is because the insurance policy, might as well start here. The insurance policy is defined as a contract whereby one undertakes, check it out, to indemnify another against a contingent or unknown loss or event. And it's a contract, therefore it's subject to contract law, and there's about 10 questions on your exam that pertain to contract law. It's used to indemnify you, right? Which means to bring you back to where you were, to restore, to make whole against something that may or may not happen. It's unknown. We don't know. And in this contract, the insurance contract is defined as a unilateral contract. And what that means is that most contracts are bilateral. Most of them are an exchange of a promise for a promise, right? You promise to do this in exchange for this. So there's an exchange of a promise for a promise. But you see, for the insurance contract, it's unique in that it's unilateral and it is not a promise for a promise. Rather, it's an exchange of an act for a promise. So Carissa, can the insurance company sue you for not fulfilling your premium payment? Did you make a
No.
promise to pay the premium?
Yes.
They are legally bound to, they're the only ones legally bound to, but I can stop paying the premium whenever.
That's right. I mean, if you stop paying, and that's what makes it unilateral, right? Is that they're the only ones who are legally bound to fulfill their promise as long as you perform your act, and your act is paying the premium.
Mm-hmm.
Which goes back to what we said earlier, right? Where the only time that the insurance company can ever cancel you is for non-payment of premium, meaning that you didn't say what you didn't perform your act, which was to pay the premium. You're not promising to make the premium, but if you fail to pay your premium, you're relieving the insurance company of having to fulfill on their promise. Let me go back here to this reserves here, though. This is really important to outline, is because what we're defining here and what we're saying is that in this mechanism of insurance, you can tell, you already know what's happening here, right? Is that the insured is transferring. What are they doing?
Transferring.
Yeah, and this is important. Anytime someone buys insurance, anytime you buy insurance, the risk management technique that you are using is that you are transferring the risk to another party. You're transferring it to the insurance company, and you're paying a small premium to protect against this potential unknown loss. But see, when the insurance company assumes the risk, they don't want to assume the risk from everyone. See, people think that just because they want insurance that they're eligible to buy it at any time. That's not true in life insurance. That's not true in disability insurance. It's not true for long-term care insurance. The only type of insurance where the insurance company cannot deny you coverage due to pre-existing conditions or evaluate you is health insurance. The ACA compliant insurance policies, they have to cover you even if you have pre-existing conditions.
Right.
However, there are terms in which you can buy, when you can buy health insurance. You can't just buy health insurance at any time either, right? So for health, we'll talk more in details about this in session 7. For health insurance, the ACA compliant plans, the ones that you're required to have as part of the individual mandate. Now remember, even though they repealed the federal penalty for the individual mandate, the law of the land is still that you have to comply with the individual mandate. There's just no federal penalty. However, the state of California has a state penalty for failing to comply with the individual mandate that went into effect this year. Now, I bring that up because all other policies, the insurance company doesn't want to necessarily assume the risk. There's a process in which the applications will undergo before they're allowed into the pool. Right? And what's that process called? Anybody know?
Oh, yeah, underwriting.
Underwriting, right? Underwriting is the evaluation, the assessing, the classification of the risk. That's underwriting. So we don't want everyone in the pool. Some people will be allowed in and others might not be. We want the job of the underwriter, the job in, or the purpose of evaluating these applications and assessing the risk is to protect the company against what we call adverse selection. Protect against. That's the job of the underwriter.
Mhm.
Protect against adverse. What's adverse selection?
Isn't that like high risk, medium risk, low risk?
Adverse selection is actually people who are higher risk.
Okay.
Their job is to protect against these high risk individuals, right? So you're right, Elise, in that the underwriter's job is to assess the risk. They may classify them as preferred, standard, substandard. However, ultimately their job is to protect against these high risk individuals. We don't want high risk people in the pool. Why? What happens to the cost of insurance if we have too many high risk people?
The insurance rate goes up,
That's right. We need more money in the pool.
right?
So then you're going to have to pay a higher premium as a result of that. So, I think when I was young and I didn't realize like how this, I mean, I knew how this all worked, but I always thought like, oh, those insurance companies. But, they're regulated. They're heavily regulated when it comes to their finances. Because when you look at, this mechanism, the insurance company's promise is only as good as their financial strength. So the insurance company's promise is only as good as their financial strength. Well, what does that mean to you?
They have to have enough money to be able to make the payouts, right? They're obligated to have a certain amount of income in to keep taking in the policies.
Yeah, well, and you're on the right track, Charles. I'm gonna give you some more words to define it, and that is the company has to be solvent. And how the Department of Insurance measures the insurance company's solvency is that they're going to look at their capital, that's the money that they have, their surplus, that's extra money, and reserves. It's not enough to have enough. It's not enough to just have enough money. So like the family that lives paycheck to paycheck, they have enough money. But what happens if like the car breaks down and they have to get the car repaired?
Credit cards.
Yeah, so which is actually not very financially healthy if you rely on your credit cards and you carry a balance, right? So
Right.
There's a question that goes something like this. If the insurer only has enough to cover outstanding liability and reinsurance, what are they considered? See, this means that they only have enough. If they only have enough, it's not enough. What do we call them?
Insolvent.
Thank
Insolvent.
you. We call them insolvent. And another way to describe an insurance company that only has enough to cover outstanding liability and reinsurance is that they're financially impaired. That is not what they're testing for on the exam. People will make the correlation that, oh yeah, they're financially impaired. That's not the word you're looking for. What you're looking for is insolvent. You want to tune your attention to the word insolvent. You don't want to be thinking about like, oh, it's financially impaired. There's certain things that I can be flexible in how we communicate and how we share that information, because you still need to be flexible when you take your exam, right? I think I said that on the first segment, is that you have to recognize that there's more than one way to say the same thing. If you're rigid and you only like keep your mind on one track and it can only be said one way, you're going to confuse yourself and you're not going to find the right answer, because you're fixated on looking for this one thing. Have you ever like focused your attention on looking for this one thing and it looked a little different? For example, my phone, right? So the phone it's black on both sides. So I was looking for it, and I set it down and I couldn't find it because I had a predisposed image, right? A preconceived image of what I was looking for. I was so fixated on finding that when I stepped away and I came back, I'm like, oh my goodness, it was right in front of me the whole time. Because once I let go of this preconceived image of what I thought what I was looking for, it was allowed in my subconsciousness to now see it in my periphery. And then I realized, oh my goodness, it was right in front of me. Same thing with the answers. If you're fixated that the answer has to look like this, it's going to be one of those 4 answers is the right answer. And it's going to be that obvious. But if you're so fixated that it has to look this way, you're not going to find it. Anxiety starts to build up and then you go down that slippery slope. So you still have to be flexible. And at the same time, there's certain things that they're going to test you on. There's certain words and language that you need to know. You're learning the language of insurance. So, students love to argue, well, financially impaired and insolvent is the same thing. You're right. And they're not testing you to know what it means. They're testing you that you can use the language of insurance, and the language of insurance is the word insolvency, insolvent. Got it?
Mhm.
And remember that the insurance industry is regulated at 3 levels. I'm going to add a little bit of code and ethics, even though we're in the life and health part of the class, right? And the 3 levels of regulation are, oops, it's going to be a little sloppy here. What are the 3 levels of regulation?
Okay.
You got the first one. What's the first one?
State.
Yep. So we've got state regulation.
Mhm.
We also deal with federal regulation. I put regulation in there. And then we have self-regulation.
Mhm.
Now, with these 3 levels of regulation, we are primarily regulated at a state level. Now, without getting into the history, because you don't really need to know the history, you just need to know that, I'll tell you a little bit about the story real quick. So insurance industry has always been regulated at a state level. And in 1944, they had something like where agents crossed state lines, and in crossing state lines and transacting insurance, they violated antitrust laws. And because again, back then, every state regulated itself. They go in this other state, they violate these antitrust laws, which are federal laws. And the federal government intercedes and said, no, you can no longer regulate yourself. This is federal. I think they called it interstate commerce or something like that. And so because it was considered interstate commerce, you're federally regulated. Well, of course, there was some confusion. After all these years, the insurance industry had been regulated by the state. All of a sudden, the federal government says, no, you should be regulated by us. Well, because of this confusion, guess what they did? They had to come up with a compromise. The compromise was because the federal government they didn't know what they were doing, right? So they came up with a compromise under what's called the McCarran-Ferguson Act. So, and McCarran is the name of the congressman who sponsored the bill. That's what usually happens, is these things are called after, they're named after the person who sponsors the bill. So under the McCarran-Ferguson Act, the 2 congress people, they gave the states back their authority to regulate and made the federal government the watchdog or the overseer of the industry.
Mm.
But the funny thing is that when you look at the insurance industry, a lot of the federal regulation regulates employee benefits. And when I reference employee benefits, what they're regulating are the life insurance products, not so much, mostly health insurance. So let me give you some examples of federal laws that we're going to cover in session 7. We're going to talk about the Patient Protection Affordable Care Act, right? The PPACA. People call it the ACA, the Patient Protection Affordable Care Act. Some people the media likes to call it Obamacare. One of the biggest pieces of legislation to affect employee benefits and health insurance, just the health insurance industry, period. HIPAA, COBRA, the Pregnancy Discrimination Act. These are all federal laws. The ADA. And there's more. This is a very short list of the federal laws that affect the health insurance industry. These are specific, though, to what we're going to cover in session 7, and federal laws that you need to be aware of and what they mean and what they do and how they affect the insurance industry and employee benefits as a whole. Then we have the industry regulating itself. And what that includes insurance companies, insurers. It also includes an organization called the NAIC. The NAIC stands for the National Association of Insurance Commissioners, the NAIC. Now, to go back to like why I'm talking about or mentioning these 3 levels of regulation is because monitoring the financial strength of the insurance company is important. It is the foundation. It is the foundation that should be included. It's the foundation of every financial plan. And I don't like to say the word should, but I'm going to say it. It should be a part of every financial plan. You know what's really funny is that I have this really good friend of mine. We've known each other for probably like 14 plus years. And when I first met him, I told him I teach insurance, and he asked, should I buy life insurance? And I said, yes. And we had an argument, and he says, I don't think I need life insurance. He's single, doesn't have kids. I said, but the older you get, the harder it is to get if you're not healthy. Because if we go back, right, to this illustration, just because you want it doesn't mean you're going to be eligible for it. See, the interesting thing about life insurance, you know how you buy it? You buy it with your health, because you have to show that you're healthy enough and that you qualify. And then you pay with your premiums.
Mhm.
You fast forward 14 years later, guess what? He's married. And he has someone that he's going to leave behind if something were to happen to him. So I brought up the conversation, hey, so what do you think about life insurance now? Right? And he says, well, I should probably buy it. I said, yeah, absolutely, you should probably buy it, because now you're together and you have a dual income household. Does she rely on your income as part of the household income? Because now you're creating a lifestyle around both of your income. And so people say, oh, I don't have anybody to leave it behind to. The best time to buy life insurance is when you're young, because the premiums are going to be the most affordable. And you have all that time on your side that if you buy a permanent policy, it can start to accumulate cash value. And it's a financial freedom tool, if not for you, for future generations. Why not plan for future generations? What if your grandparents thought like that? That's how, the elders of native traditions, right? They try to think 7 generations into the future, and life insurance is one of those tools. It is the foundation to every financial plan, just in case something happens. You have this in place. You have insurance in place. Not only is it the foundation to your personal financial plan, it is the foundation to our economy. Because if you look at the 3 levels of like the financial services, right? I'll start a new slide for that. You've got investment banking. We have banking, and then insurance. And of these 3 industries, which one is the most regulated?
Investment?
Insurance. Investment, if they were the most regulated, Elise, I don't know if we would have had the Great Recession of 2007, 2008, or whatever time period you want to reference that.
Okay.
When the Great Recession happened back in, 1929? I hope that's the right year, because we're recording this and I should know that. After the Great Recession, they passed a law, Congress passed a law called the Glass-Steagall Act. And under the Glass-Steagall Act, it kind of created, it created these firewalls between these 3 industries. And the purpose of the firewalls is to prevent the Great Recession from ever happening again. I'm sorry, the Great Depression from ever happening again. Well, slowly in the 1980s, our economics started to change. And in the 1990s and in the late 80s, we started to see some deregulation take place. And in, I believe it was in 1999, President Clinton formally repealed the Glass-Steagall Act. And in repealing the Glass-Steagall Act, right, guess what? We had 2007, to 2010? We had the Great Recession. And during this time, right, there's a couple of white papers that actually say that the repealing of the Glass-Steagall Act was responsible for this. But, all scholars have their opinion, right? But now we fast forward, and there was a time when you could not go into a bank and have access to insurance and investment products. After 1999, these firewalls were taken down, and insurance companies owned banks. Banks own insurance companies, and they all got into each other's business. Does everybody get that?
Mm-hmm.
The industry, though, that has the most regulation is insurance, though. See, insurance is all about protection. Slow and steady. This isn't about day trading. It's not about what's my ROI? That's not what insurance is about. Insurance is about protection. Investment banking is the total opposite. Because over here, guess what? The greater the risk, what?
The greater the benefit.
That's right. The greater the risk, the greater the return. And guess what? We're not about protection. We're about what's my ROI. And people are oftentimes willing to take a greater risk over here, which but you also want to manage the risk and you want to find ways to mitigate it. You don't want to be reckless. But over here, all we're doing is we're looking for protection. So part of the plan needs to have that protection in case something happens. And then on top of that, you can build and you can take more risk because at least you have the foundation in place. And I think this is just it's such an important framework to what insurance is, and we don't talk about that. I don't think people talk about like why it's so important, right? We just talk about buy the protection because you need it, right? Well, why do I need it? Well, in case something happens. Well, nothing's going to happen to me. Well, you know what? Something is going to happen. You just don't know when it's going to happen, right? You just don't know when. But this is a mechanism of insurance. We're like bumping up against 12 o'clock right now. And I'm actually, I did this very different than the way I normally teach this. I don't know if you remember, Kristen, the first module, I did not. It was a total different
Yeah.
conversation. I usually start with the mechanism of insurance first. I usually start with this first. But I wanted to start a little bit differently because I just noticed that we need more framework around what insurance is and why people need insurance. And you need insurance from the very beginning. The younger you buy it, the more affordable it is for the individual and for the family, right? This is the essence though, and I'm really glad that we talked about it from this place because I actually covered more material talking about leading the conversation this way rather than the conversation I normally have when I start with the insurance basics. But this does give you a lot of foundation. We talked about peril, hazard, the two different types of risk, pure versus speculative. Which one's insurable?
Pure.
Pure risk. What's the definition of a speculative risk?
Ability of gain.
Loss or gain. What's the definition of a pure risk?
Loss. I mean,
Loss or no.
Loss or no loss?
yeah.
Loss or no loss. Thank you. Loss or no loss. Exactly. And we're primarily regulated at what level for regulation, for state regulation? Oh, I just gave you the answer, darn it.
Mhm.
We're primarily state regulated. Let's see. Anything else? I think that's pretty much it. We're going to have some more time in the afternoon. And so the afternoon session is life insurance contracts. I'm going to email you a handout of what I would normally hand out on the first day of class. So if we were in a live face-to-face class, if you were here in the office with me, I'm going to email you those notes. And what those notes include is a summary of the first segment. And then it will also include the like a summary of the life insurance policies and a place for you to fill in the answers. So you can either put it on your notebook or you can print from the computer this handout I'm going to send you and then write directly on the handout so you have notes. And it'll follow what we're going to talk about for the life insurance policies. That section is worth 10 points on your exam. It's worth 10 points on your exam. This afternoon segment. And then what we'll do is I want to go back to this piece here. So I'm going to make a note. We're going to go back to the insurance policy and then we're going to talk about risk management. All right. Any questions for me?
No.
No? Okay.
Just
You guys
a
ready for
quick
yes.
question. You were stressing the foundation of every financial
Plan.
Mm.
Every financial plan should have an element of insurance. Like what if something happens? A contingency plan, right? What funds the contingency plan? Well, you have insurance in case something happens.
Right.
I'm sure all those individuals who had, and I don't think there was a lot of homes that were actually burned in these fires that we've had recently. I've been keeping track of the SCU fire because I live down in San Jose and we were actually on the border. We actually got evacuation warnings and stuff like that. I think that they had maybe
Crazy.
24 buildings. That's not a lot compared to the NorCal fires we had a couple years ago.
Yeah.
And so, and the loss of life is not, I mean, it's sad, and it's not the kind of loss of lives we've had in other fires either. And so it's the losses when you compare them are is more of the land that was burned, right? And then
Mhm.
the toxicity of the smoke. And see, those are the
Mm.
things that we don't look at, and we don't even measure. Like, we don't really know the health implications of all of that smog and the smoke. That further exacerbates the losses from those fires. But I'm sure they're not gonna measure that as part of or attribute it to the fires. It's gonna be something else. You know what I mean? Because that's just how we look at risk. We look at losses. How do we look at losses? What lens?
Mhm.
All right. Any other questions? Charles?
No
No,
questions. Nada.
Carissa? Did I say that right, Carissa?
Actually, yeah, it's Carissa. I mean, I don't mind either way, but
Oh, yeah. Well, I'm Latina, right? So I'm going to look at that as Carissa.
yeah.
All right. So let's go ahead and let's do this is our second time doing it together. So go ahead and find yourself in a seated position with your feet flat on the ground. Lining your back, inhaling your arms up high to the sky, reaching for the stars. Exhale, go this way. Nice big stretch. Inhale, go the other way. Exhale, go what's that? Too fast. Inhale back up to the top, bringing your hands in front of you. Let's lock it in for easy access at any time. Ready? 1, 2, 3. Awesome. I'll see you all at 2:30. What time?
2:30.
2:30.
2:30. 2:30. And I'll stay on for a couple minutes if you have other questions.
Okay.
All right, I'm going to wrap it up. Good night. See you at 2:30.
Bye-bye.
Do you have any questions? Good. Okay.